Hello, my viewers. This is Dr. Adesina again from ftplectures.com. Today we have some special information for you regarding student loans. Getting education is very, very exciting, right? You go to college, with a medical school, get an MBA, graduate school, and then you graduate with this large amount of student loans, either going through Navient or going through federal student loans, right, or private loans. But the downside to the student loans is that they often come with a tag, which is a price tag of a high interest rate. Now, students often don't think about this when they actually start their education. Now, right after you graduate, you get a letter or an email notification tell you that you have a 6-month grace period before you start paying back your student loans. And that's when the reality hits. A lot of students find out that it is very, very expensive. You've got a lot of interest ranging from between 6% to 8%, right? We're going to take, for example, medical professionals, right? You go to medical school, right? Dental school, nurse practitioner school, and you come out with an average between $100,000 to some people even ranging to $300,000. Now, if that number doesn't scare you, you should step back and think about it again. And then they tell you, hey, you're going to be paying this back for the next 30 years. Now, if you're people like me, I'll be like, 30 years is a long time to pay back a student loan. But not just the student loan, it comes with interest. So a loan of $300,000 over the course of 30 years, you might end up paying between $400,000 to $450,000 back in student loan interest. Now, if you take that $100,000 and put it towards something else, retirement, right? You know that's going to go a long way. So today, I'm going to share with you one company that has revolutionized the refinancing of student loan industry. This is just one of many. This company is called CommonBond. Now, CommonBond is a privately owned student loan company, and what they basically do is that they buy your student loan. So what was it founded? Well, CommonBond was founded by 3 Wharton graduates who thought, why are we paying ridiculous amount of money for student loans? Why can't we pay less in interest so that you can keep more money in your pocket? So I'm going to read some of the information that's going to be vital so you can make a good decision, and why I think you should also go with CommonBond. So CommonBond often offers a low fixed or variable rate student loan products, usually offered to students after graduation. So why is CommonBond special? Well, the reason is because they offer us a first-class customer service. They also offer a variety of low interest rate products, which I'm going to talk about in this video, and the access to talented, successful community of members who help sustain this company. So this is a very, very reputable company. So next question is, how much can you refinance? Well, you can refinance up to $500,000 with CommonBond. So what is refinancing and what type of loans can be refinanced? Basically, what refinancing simply means is that when you refinance, you take out a new loan to pay off an old loan. So for example, you went to medical school, right? You graduated $200,000 in student loans, and you're stuck with a 6% interest rate. So this company is basically buy your loan out and give you a lower interest rate. Who can refinance? You have to be a U.S. citizen or a permanent resident for you to be able to get this opportunity. So students are going to be like, okay, why do you think I should switch? Why should I refinance? What's the downside with going with another privately owned student loan company rather than Navient or federal student loans? Well, I'm going to tell you the difference. So with privately owned companies, for example, CommonBond in this case, what they do is they basically offer you a new interest rate that's calculated based on your credit history and overall financial health, which means they look at how much you're making, look at your credit report and your credit history, and they use that to determine what rate you're going to be offered. Also, this privately owned company, which is CommonBond, basically take multiple federal and private education loans are combined to create one loan, and you get one monthly payment. On average, listen, this is important. Common bond members save $14,581 by refinancing to a lower rate. But there's a caveat. Remember, when you refinance federal student loans with a private lender, you forgo the federal student loan protection, such as public service forgiveness and income-based repayment plans. So, federal student loans, they do offer income-based repayment plans. For example, if you're a resident, you might only be paying $150 a month. On your student loans, they might say that's because you don't make enough money. You're making just maybe $30,000, $40,000 right now, and you owe $300,000. We're not going to hold you responsible to pay the whole huge amount of maybe $3,000 or $2,000 or $1,500 a month because you cannot afford it. So if you go with a privately owned loan like Common Bond, you're not going to be able to get that option. So that's one thing I want you to know when you decide to make this leap. Now, you might say, well, I'd rather stay with having, IBR, which is income-based repayment. But wait a minute, there's a catch. If you go with the direct loan consolidation route, which is just the federal loans, it's the same thing. They take all these multiple loans that you have, they consolidate into one student loans, and you make one monthly payment. However, the interest is being determined by the average rate of all loans being consolidated. What does that mean? So let's say you have a Stafford loan, for 6%. You have also a federal student loan for 5%. I'm just making up numbers here. You have another loan for 8%. What they basically do is they add a 5 plus 8 plus 6, and they divide by 3, and that's how they determine your student loan rate. So roughly, you might still be ending up with a higher interest rate. Also, overall, you may be able to extend the length of your loan, and this will lower your monthly payments, right? So rather than paying, $2,000 a month, they might say, okay, just pay $500, $600 a month. And that sounds like a great idea, but the problem is that over a longer period of time, you're going to pay more money because you're paying more interest. So it sounds like a convenience if you go with the federal student loan rate, but overall, it's still going to cost you, and it's not a money-saving plan. So what's the difference between a fixed rate and a variable rate loan? Fixed, just the word fixed, right? If we give you 4% rate APR on your student loans, it's not going to change regardless of inflation. So you're always going to pay 4% for the entire length of the student loans. However, a variable interest rate means it's going to fluctuate in with the market benchmark rate. And they always use the LIBOR website, which is the standard they use to determine what the average student loan, the average interest rate varies over time. Let's talk about what kind of rates this company actually offers. So how much does the loan cost? Well, remember, your interest rate is dependent on your credit profile, okay, and also your credit history. So make sure you have good credit history to go with this company. So they've got a couple of options. They have a 5-year plan, a 7-year plan, and a 10-year plan. And each year, if so the 5 years can either be fixed or variable. So 5 years, 7 years, 10 years, fixed or variable plan. So for their 5-year term of the interest rate, which is fixed, the rate is between 3.5 to 5.99 with auto payment discount. Also, the 5-year variable rate goes between 2.23 and 5.03. Remember, currently they're using the LIBOR interest rate. So currently the 1-month LIBOR is about 0.53% right now, which may change in the future. That's the only downside with variable interest rate, because as the LIBOR rates changes, basically your student loans rate also can change. Over the 7-year loan term, their fixed rate is ranging between 4% and 6.49%, and their variable rate is between 2.53 and 5.16%. Their 10-year loan plan at a fixed rate is between 4.61% and 7% with an auto discount, and their starting rates for their variable rate at a 10-year plan is 3.03 and 5.41%. They also have different hybrid loan options available. Now, if you opt in for the auto payment every month, you get 0.25% automatically discounted off your student loans, which means if they gave you 2.5 initially, you get 2.25%, which is a steal. It's a great deal. If you can afford this option, I would highly recommend you make sure you go on their website once they approve your loans for refinancing, and then just put in your bank information and they will be able to give you that discount, which means every month automatically they take out a specific amount of money. So what is the terms of the loan if you decide to go to common bond? Well, all of their refinance loans have these common features. Basically, there's no origination fee, and their monthly payments often start within 30 and 60 days after your refinance your loan has been dispersed, which means they just go, they take $300,000, they send it to basically a current loaner, and basically they take over your loan and they give you a lower interest rate. There's also no prepayment penalty. All payments greater than the monthly minimum go straight towards your principal. Academic deferment is available if you decide to go back to school. And they also have an option for financial hardship forbearance. So if you're having a hard time, you just call up the company and tell them, hey, listen, I can't really afford these loans right now, and they'll definitely be able to help you out. So if you'd like to save over $14,000 on your student loan right now, I want you to click on the link below here, and it will take you straight directly to commonbond.co and allow you to be able to sign up. It's really, really easy to sign up. Basically, they're going to ask you for a lot of personal financial information to be able to determine if you qualify. And once you qualify, they basically accept and they basically disperse your loan out. They pay it off. You got one simple loan to be able to pay all in one lump sum. You don't have to worry about paying different loans every month. And obviously, you get a lower interest rate. I went with this company, and I have to tell you, you have a great customer service. I highly recommend them. If you're going to refinance your student loans, stop overpaying too much money in interest. Common Bond is a great company to go with. I highly recommend them, and they've given me a very, very lower interest rate, even on my own personal student loans from medical school. Thank you very much. Don't forget, click down here to be able to click on the link and get straight to the website to be able to sign up. And also don't forget to click on the subscribe button right at the right top hand of my page here. Thank you very much for watching. Have a wonderful day. Bye-bye.